Hello and everyone. It's great to welcome you to this lovely venue. It's always such a pleasure and always so insightful to meet with our clients. So, I hope that I've met most of you now, but my name is Jake Higgins. I oversee our investor relations. I've been on the team since the outset, since day one. So it really is an extra special pleasure to see you all here tonight and see how far we've come. I was just talking to Mr. and Mrs. Desai. They've come from Swindon, so 100 miles away. But no, they said they've come to see the crown jewels and some other things as well, so not all property partner. I think alongside Rob and his team, they are probably the only people in this room who have actually been to the Swindon property as well, I gather. You should get them after while we're having drinks and some food and ask them about that. But without further ado, we have three speakers here this evening. Two from Property Partner, Mark Whedon, our Head of Research, Robert Weaver, our Director of Property, and from outside the Property Partner team, but somewhat now a regular at these quarterly investment seminars, Mr. Alan Higgins from Coutts Bank, where he's Chief Investment Officer. So Alan, yes, keen interest in fintech. We're looking forward to him giving us an investment update here today and touch on some investment themes. We've managed to drag him away from CNBC or Bloomberg or wherever he is. But without further ado, Alan, if you could please join us here.
Good evening, everyone. Well, it's wonderful to be here. Thank you, Jake. And yeah, I have to say, first thing, looking at this incredible view that we're sharing, you're paying way too much in legal fees. What is, surely maybe in Swindon we can find a cheaper lawyer. It's quite incredible. But so what I'm going to share with you first, Jake, thanks for inviting me back, because one of the reasons I was keen to get back, I see some familiar faces and some new faces, is that I did such a bad job of explaining how investing for income can generate capital gains. I thought I'd have another go. I've even got the example of Unilever, which we're going to look at as in my world, because my world, working for Coutts as CIO, is primarily equity, fixed income, some commercial property investing, some of these buildings here via funds, less so resi, but really from day one, I've really liked the way that these people focus, not entirely on yield, on income. Income investing is my background. I started off as a bond investor. Bond investing today generally is not where you go to get a yield. For example, if you're to give money to the UK government for 10 years, they'll pay you a paltry 1% per year. Really quite incredible. So I'm going to share some thoughts. I know Jake is leaving time at the end for questions to all of us, but if I say something completely crazy or you just have a burning issue, I'm very happy to take a question as we go. And I think I've got a couple of slides to look at just at the end. But right-hand side. Yeah, I might have with my yoga bunny's in the way. I'm focused on the yoga bunny only. Thank you, Jake. Technology is not my strong point, but there's strong tech people here clearly. Okay. So let me share with you what we tell Coutts clients. So it's an insight. It's a pleasure to do this Property Partner. I was explaining earlier that one of the features of my role is I get to do this in various other places as well, but not that many. So it is quite unique to Property Partner in terms of the time that we're willing to get involved. And we know the chairman, Ed Ray, who's, of course, that some of you may remember Betfair very well, also here at Coutts. Okay, so key point, if there's one message that I want to give you is don't wait around for higher interest rates. They're not coming. And I'm afraid that despite inflation edging up, the Monetary Policy Committee of the Bank of England are not raising rates. And even when they do raise rates, we believe they'll be circa 2%. The days of 5% rates, wasn't that so long ago? 10 years ago in 2007, that will seem like a distant dream. And those of you who've heard this before, but it's worth saying again, because I've got it at Coutts in the archives, 1991 cash TESAs before ISAs, Nationwide Building Society, 1 year rate, 16%. Seems like from Mars, right? The Coutts prediction is that 5% will seem like from Mars going forward. And we're not just saying this now. Mark Carney at the Bank of England is also saying this. He was asked a question, a direct question, when will rates get to 4.5? He said, forget that, divide by 2. So very precise, so 2.25. So you know, that's kind of, and it seems right. We're in a low interest rate world, and it's not just central banks. I'm happy to take some questions on that. So what does that mean as investors? So me looking at the world of equities or bonds or property partner, and why I like the property partner approach so much in terms of income, is that any interesting mathematical source of income stream becomes very, very attractive. That's kind of the science part. The team does the science. The art part is, how will that income stream get repriced, or can it grow? And that's really what I want to touch on. Before we go into that, let's talk about geopolitical issues. I think I was lucky enough last time to speak post-Trump. We're not always right. As an investor, it's very humbling. Wrong all the time. That's the nature of investment. Try to be more right than wrong. But I think those of you who were here hopefully will remember on Trump, we were relatively upbeat. Why? Not about him and his crazy personality and the crazy tweets, but the substance. The substance meaning basically Reaganomics, a low tax environment. And yeah, trade wars, but guess what? Obama has put on tariffs on steel. Reagan was huge on tariffs. He put tariffs on just to protect one industry. I don't know if I mentioned this last time. Anyone know in fact, just no, not one industry, one company. He put tariffs on Japanese motorcycles above 700 cc's to protect Harley Davidson. So it's not unusual in the US system to see tariffs. Tariffs okay, trade war very bad. Will we change our mind? Full on trade war, yeah, we'll change our mind. But tariffs, don't be worried about those. Brexit is an issue. We do think there is an end game, certainly a transitional period where we pay some money, despite the latest kind of statement from Theresa May saying we'll walk away and not pay anything. And on the one hand, you have the EU saying you owe us 60 billion. That's kind of a nice kind of contrast, 0 versus 60 billion. There is a middle ground here where the UK pays and we have some kind of access, and then we sort it out. But before that we get there, we've got the French election. And you've heard about experts. I'm pleased to say I'm not an expert. I'm just an investor. It was Michael Gove, wasn't it, who said, we've had enough of experts. Getting Brexit right, getting Trump right, and now we have the French election, of course. French election, on the face of it, looks really serious. Why? Because Le Pen says she wants to come out of the euro. So we're coming out of Europe, but of course we've still got sterling. Coming out of the euro basically means the euro breaks up. So on the face of it, looks very serious, and there'll be a lot of comments along those lines. But anyone here know French politics in any detail? I might get you to speak up. We have got a couple of French people in our team, thankfully, because it is a very, anyone who knows who's done anything in France, I bought a property there. It's a very bureaucratic system, and their politics is even more bureaucratic. They have a parliamentary system separate from the president. So let's say Le Pen makes it. She cannot force a referendum, let alone get the people to vote to break up the euro. It's a parliamentary system. So there'll be a lot of tussle, but it doesn't necessarily mean the breakup of the euro. And furthermore, the euro is popular in France. It is popular in France. So it's actually also popular in Greece. The one country, anyone know that? That's why Greece couldn't pull out. That's why the politicians had no power. The politicians in Greece had zero power because the people wanted the euro. It's the only thing that they had. There is one country where the euro is not popular, or it's about 50-50. Any idea? Anyone want to throw a guess? It's late. Did I hear? Italy? It's right, Italy. Look out for the Italian elections. Don't worry too much about the French elections. We are worried about the Italian elections because that is a country where, I say, the euro is much less people are much less positive about the euro in Italy, and therefore it's much more possible that the government could vote for a referendum and they could win it and leave. So that's the one to look out for. Most likely next year's story, but certainly that's something to look out for. Right, so I said invest in income streams. So where do you get income streams? Obviously property partner. In my world, equities and bonds. How in bonds I just mentioned about the government bonds, and I know we've got a wide range of investors, some very advanced one here. In equities, typically, you don't get the full earnings yield. So those of you who've owned businesses, when your company makes £1 million, all that £1 million is potentially yours. When you're an equity investor, you get the dividend, the discretionary dividend. But that can be very powerful. And what I want to highlight is there's two basic ways you can make money from income investing. The first is we call it Mr. Market. So Mr. Market isn't someone here, strangely saying something. Mr. Market is where the market prices thing. So it was a phrase invented by Warren Buffett. So Mr. Market moves the yield up and down, whether it be on property or whether it be on shares. So, for example, Unilever shares at £40 yield 3%. We'll have a look at that at the moment. If Mr. Market decides that yield at 3% is inappropriate, it should be 2%, then the share price goes up 50%. So that's one way of making capital gains. To put it into property partner world, I don't know if it's your latest edition, but your Tooting Mitcham property is on a gross yield of 5%. I know property partner does it very fairly. They allow for voids. They allow for some replacement work, and some taxation is already taken out. So I know you quote lower, but the gross yield is 5%. Is that right, Rob? So if Mr. Market, in this case the property market, says that 5% is too high, then it should be 4%. I think it's currently you paid in round figures 600. Then if it goes to a 4% yield, it becomes worth 750,000. So that's one way of making money, but also losing money. I haven't talked about losing money. If Mr. Market takes that Tooting property and takes it from a 5% yield to a 6% yield, you get associated loss. And it's the same in my world and equities and bonds. But I just want to share to you the other way, which is to grow the income stream. So one of the great attractions of property, commercial, residential, and equities is you have a growing income stream. So if you have my first, I'm in control. I'm not used to this. Where's my helper? Okay, right. Okay, it looks like a complicated graph, and because but bear with me. And this is not a recommendation to buy Unilever shares from Coutts. Absolutely, be very careful. But Unilever, I thought I'd bring in because some of you might be aware that Buffett tried to buy it. Buffett tried to buy it. So why? So what have you got here? So we've got the dividend yield and the dividends per share. So if you look at the dark blue is the dividend. Not dark blue. Let me get it right. The dashed line is the dividend yield. You can see in 2000, when we had the tech bubble, it was on a yield of 3%. Today, big picture, you can see it's on a yield of 3%. In between, Mr. Market, remember I mentioned Mr. Market, moves that yield up and down, up and down, up and down. Along the journey, you'll have profits and losses, as Mr. Market moves that yield up and down. Obviously, it's good to buy low, right? Sell high. But in case of yields, you want to buy into high yields if you can on Unilever. But what we've got also is what's happened to the dividend per share since 2000. It's gone from roughly 25p to over 100. It's quadrupled. Quite incredible. These are called, in my world, we call them dividend aristocrats. These are, it sounds like they should be Coutts clients. We do have a few, obviously. And this is actually a company that's managed to increase its dividend every year. So I'm choosing a really good example of equities here. Quite some competition, I'm afraid, for Property Partner. But there's plenty of shares that have cut their dividend, including my parent bank RBS, which currently pays 0. So there's risk along the way. But the point being, that's interesting. Let's just think about this. So it started on a 3% yield, but the payout has gone up 4 times. So if let's say the share price is completely unchanged, guess what the yield on Unilever would be today? 12%. Because the payout's gone up 4 times. There's no way Unilever would be on a yield of 12%. That'd be crazy. So therefore, what happens to the share price? It has to go up. It has to go up. So what we've got now is simply the share price, Mr. Market, and the dividend per share. So this is really long-term thinking. And you can see, so the yield's unchanged. So over this long period, the yield's unchanged. 3% to 3%. Yet, from having an income focus, or more correctly, having a growing income focus, you've made tremendous gains. This risk warning, this may not continue. Unilever may cut their dividend. They may get into all kinds of trouble with their Marmite and their Magnums. 2 things I both like, unlike most things. But companies do get into trouble. All kinds of good companies. BP's got into trouble. So please be careful. I'm using a perfectly good example. So I suppose the challenge a little bit is that, but also the attraction of residential property is now to compete with Unilever, Rob and Mark. I know it's a really tough one, but you do get a growing dividend income stream, and we will know this anecdotally. When I first came to London, lived in Peckham. God knows what the rents were. For a 2-bedroom flat, they were probably £300 a month or something. No one wanted to live in Peckham. Strangely, we did, but that's a long story. Now, renting a 2-bedroom flat in Peckham, what, £2,500 a year? £2,500 a month, rather. It's so it's a hot place. It's where all people Jake's age want to live, allegedly. Is that right? Is that right? Allegedly. So that's an example of almost local rental growth. It's almost like comparing it with Unilever. So it is certainly possible to get rental growth. And therefore, because of that rental growth, if the flat in Peckham stayed the same, it would be on an absurd yield. And therefore, of course, the price goes up. So hopefully I did a better job than last time. I don't know, it's for you to judge, on explaining how investing for income, either on an outright basis, say tooting at 5%, you make a judgment that seems too high on a gross basis, or in a growing income stream, that can make you capital gains from any kind of investment. And I'll stop there. Very happy to take some questions on Brexit, Trump, etc. But I wanted to get this bit right. Sir?
Specific question on the graph.
Yes.
What explanation do you have by the two lines converging they start off very apart, then they converge, and then they mostly track each other as they go in.
I think it's the scaling thing. It's the trick. It's the property partner team. Put this together for me. And probably the main message is there's two scales: the left-hand scale and the right-hand scale. The main message is that the dividend per share has quadrupled. What a lovely experience, right? So you buy something in 2000, a long time ago, but 17 years later, you're getting 4 times the income, and the share price has quadrupled along the way. So, it really, it sounds like I'm more an advocate for equity investment myself, so with apologies, but they're not all like this, please don't buy Unilever just because I'm talking about this. Please don't. Some people think it's an expensive one. So it looks like they converge, but the main message, if you look on the right-hand side, dividends have gone from 25 to 100, quadrupled, and on the left-hand side, the share price has gone from £10 to £10 to £40. So the share price. So 2 different scales. I'm going to have to come back next time because obviously my graphs don't explain the situation as well, but that gives me an excuse to come back another time. But that's enough from Coutts. I think it's time to hear from Property Partner. I'm absolutely fascinated myself to hear. Okay.